I think the market, aftermarket trading is more about the surprise of guidance. They beat handily on their already bullish guidance for the first quarter, largely on the cloud because everybody's at home. But PCs also did better too. The revenue guide for next quarter is above consensus, but their EPS is below. It's clear the margins are going to deteriorate here for a number of reasons they're going to get into in the call. It starts in about 15 minutes.
Why any idea why those margins are going to decrease? Because as you said, the Q2 guide on the revenue line was pretty strong.
Yeah, there's a number of things that were supposed to affect them in the second half of the year that are probably being pulled in the second quarter now. Most notably is their new product, the two new 10-nanometer products are starting to ship. And the cost associated with the initial shipments is always much higher whenever you're getting to the next node. And they guided for some materially lower margins in the second half on that. You're probably seeing some of that in the second quarter. And also mix is going to start affecting them now too. They've freed up a lot more supply. If you remember, Intel's been constrained. They couldn't ship enough of the PC processors to the low-end market last year for almost well over a year now. And now that they have supply, they're starting to fill those orders and the mix goes down. So I think both of those effects are probably hitting them in 2Q. Revenue goes up, margins go down.
The data center business division up 43%, Mike, certainly a standout. How do you regard Intel, the move that we're seeing, the move we've seen so far this year, and whether it's a bellwether for the broader industry and the broader market?
It's not so much a clear bellwether for the industry, only in the sense that it tends to be kind of the quality, somewhat more defensive, slower moving option. And in that way, it actually, on a stock basis, has been a beneficiary of this environment. I mean, this stock has not spent any time in recent years above about $60 a share, except for a brief period, late last year, early this year. So it's actually held up relatively well. So I do think it's a matter of whether investors are going to prefer to sort of hide in these areas that maybe aren't growing as fast, but can hold together and have strong balance sheets, or if it's going to be kind of moving toward the more aggressive parts of the sector. And that's just not clear exactly. It actually changes from day to day.
Ed, do you get worried when you see the disconnect stocks like Intel, or we could broaden it out, broader subsector, or even the NASDAQ itself, only down 5% year to date when you see the rest of the market suffering much more?
Yeah, definitely. I mean, in the panic that we just suffered through here, investors either go to cash or they go to some of the big caps for security. If you look at the top three semiconductor companies, Intel, Qualcomm, and Avago, or Broadcom, Broadcom took a terrible beating in the down cycle because they're more highly levered. They've got $42 billion in debt. They've come back a lot since then, but they're even more exposed to the data center. So if it was just fundamentals, you wouldn't have done that. But if you're highly concerned about the stability of the company, you go to Intel because there's no doubt their cash flow and their balance sheet, they're going to weather the storm. So I think you're seeing a bit of that. As we come out of this crisis, naturally people will start heading back to the more aggressive stocks.